When that request of yours landed on my desk for us to do a deep dive into this Goldman Sachs report,
Yeah.
if not now, when? 10 reasons to buy China equity.
Mm-hmm.
I knew we were in for an interesting conversation.
Yeah.
And to make things even more juicy, I guess,
Yeah.
we've got that fresh Ministry of Finance press conference from October 12th.
Right.
Adding another layer to this whole China puzzle.
Yeah, it's certainly a pivotal moment, I think, for China watchers and investors alike.
Mm-hmm.
There's a real sense of uncertainty in the air right now about which direction the Chinese economy is heading.
Yeah.
And this Goldman report jumps right into the heart of that debate.
It does feel like everyone's trying to decipher the mixed signals coming out of China right now.
Absolutely.
What I found really interesting is that Goldman doesn't just tiptoe around the uncertainty. They come out swinging, claiming that now is the time to invest in Chinese equities.
Yeah, and they back up that bold claim by pointing to the sheer scale of easing measures that China has rolled out since late September. We're talking monetary policy, fiscal policy, targeted support for the property market, and even direct efforts to boost the equity market.
Wow.
To put it in perspective, Goldman doesn't hesitate to call this the most significant easing package in recent history.
That's a lot to process, especially for those who've been following China's economic ups and downs over the years. We've seen this kind of stimulus talk before.
Right, and the report acknowledges that many investors are experiencing a kind of policy fatigue. They've seen these grand promises of reform and stimulus before, only to be left underwhelmed. What makes this time potentially different, according to Goldman, is the depth, the targeting, and frankly, the communication strategy around these policy moves.
So it's not just a repeat of the same old playbook. They're trying something different this time.
It appears so. One of the most significant shifts is the emphasis on demand-side stimulus.
Okay.
In the past, China has relied heavily on pumping money into infrastructure projects and propping up state-owned enterprises, a supply-side approach. This time, they're talking about putting money directly into the pockets of consumers, encouraging them to spend and drive economic growth from the ground up.
That sounds like a pretty significant shift in thinking. Instead of just building more factories, they're trying to boost the spending power of everyday citizens.
Precisely.
Okay.
And they're putting their money where their mouth is. The People's Bank of China, or PBOC, has introduced a new swap facility and relending programs designed to specifically encourage stock buybacks.
Okay.
Now, while these moves may not technically qualify as full-blown quantitative easing, or QE, they send a very clear signal to the markets.
It's like they're saying, we've got your back. Don't bet against the Chinese government when it comes to supporting the equity market.
Exactly. They're putting a floor under the market, and it's certainly caught the attention of investors. Since those September lows, we've seen some impressive rallies in both the MSCI China, which tracks Chinese companies listed in Hong Kong, and the CSI 300, an index reflecting the performance of the 300 largest companies listed on mainland Chinese stock exchanges.
So, after a bumpy ride, is it finally time to hop on the China bandwagon? Or could this be another one of those head fake rallies that leave investors disappointed? The report doesn't shy away from drawing some interesting parallels to another major Asian economy that faced its own set of challenges.
You're talking about Japan's experience, right?
Exactly.
The lost decades where they struggled with sluggish growth and deflation despite implementing a series of easing measures.
Exactly. Is China headed down the same path? Or are there fundamental differences that could allow them to avoid Japan's fate?
The report acknowledges the similarities to Japan's experience, particularly those bear market rallies driven by policy shifts. But it's important to note that they don't view this as a one-to-one comparison.
So what makes China's situation different? Why wouldn't this just be another case of those rallies fizzling out?
Well, for one, China's demographic picture is much different. They have a younger population and a more dynamic, tech-driven economy compared to Japan's aging population and reliance on heavy industry at the time. Additionally, China has more fiscal wiggle room, more tools at their disposal to try and steer the economy.
So they've got some advantages that Japan didn't have. But even with those differences, the question on everyone's mind is, can this recent rally in China actually last?
That's the billion-dollar question, isn't it?
Yeah.
And the report, while optimistic, doesn't offer any guarantees. It does, however, offer a compelling case for why Chinese equities might be undervalued right now. They use this interesting phrase referring to them as inexpensive call options on potential growth.
Inexpensive call options. That definitely piques my interest. Break that down for me. It sounds like investors might be getting a good deal here.
That's essentially the argument. Think of it this way. Valuations are relatively low right now because of the recent dip in the market. This creates an opportunity for what they call multiple expansions, meaning the potential for stock prices to rise significantly, especially if these policy changes gain traction.
So it's about the potential upside based on these suppressed starting points. But it's not just bargain hunting driving this rally, right? There's some genuine fear of missing out happening here, too.
Absolutely. The report acknowledges the FOMO factor, investors seeing those rallies and not wanting to be left behind. But they also point to the fact that investor positioning is still relatively light. This suggests there's room for more capital to flow into China, potentially fueling further gains.
It's a combination of FOMO and fundamentals, an interesting mix. But let's talk about the actual companies. Is the earnings picture looking brighter, too?
This is where it gets even more interesting for investors.
Okay.
Goldman has actually upgraded their earnings per share, or EPS, growth forecasts for MSCI China for both 2024 and 2025. They're now projecting 12% growth for both years.
That's a significant jump. What's driving that optimism?
Several factors are at play. The anticipated impact of those stimulus measures. For one, they also point to the recent appreciation of the yuan against the U.S. dollar, which makes Chinese exports more competitive.
And a strong yuan also makes investing in China more attractive for foreign investors.
Precisely. It's all connected. And finally, there's a belief that we could see a significant consumption pickup in China, especially if these demand-side policies work as intended.
Okay, so we've got a potentially undervalued market, upgraded growth forecasts, and a government that seems determined to support the equity market. It's starting to sound like a pretty rosy picture, but I know you always like to look at both sides of the coin. What could go wrong here? What are the potential risks that investors need to be aware of?
You're right. No market analysis would be complete without considering the potential downsides. And the report doesn't shy away from that. One of their primary concerns is the ongoing struggles in the Chinese property market.
That's been a drag on their economy for a while now. Ghost cities, over-leveraged developers, it's a complex issue.
Exactly. And while these new stimulus measures are designed to address some of those issues, the property market is notoriously difficult to predict and even more difficult to control.
So even with all this government intervention, there's no guarantee that they can fully fix the housing hangover. And that could spill over into the broader economy.
It's a real risk,
right, and
one that investors need to factor into their calculations. But even with that caveat, the report still leans towards optimism. They argue that the demand-side focus of this stimulus package could be a game changer for listed companies, especially those in consumer-facing sectors.
That makes sense. If Chinese consumers start spending more, those are the companies that will directly benefit. So we've got this internal balancing act with the property market, but there's also a huge external factor looming on the horizon, right? I'm talking about the U.S. election.
Yeah. Ah, yes. The elephant, or perhaps we should say the donkey and the elephant in the room.
Right.
The U.S.-China relationship adds a whole other layer of complexity to this equation.
It's the ultimate wild card. Depending on who wins and what policies they pursue, we could see anything from increased cooperation to heightened tensions between the two economic giants. And let's be honest, the rhetoric around China tends to heat up during election season.
Precisely. And that's why the report dedicates a significant portion to analyzing the potential impact of the U.S. election, particularly the possibility of increased tariffs on Chinese goods.
Which, let's be real, has been a bit of a roller coaster ride these past few years.
Absolutely. But what's fascinating here is that they don't just throw their hands up and say, who knows? They actually try to quantify the potential impact, running different scenarios.
So what did their crystal ball reveal? How much damage could those tariffs actually inflict on the Chinese economy and the stock market?
Their analysis suggests that a significant increase in tariffs would undoubtedly have an impact on valuations. But, and this is crucial, they also identify several factors that could potentially mitigate that damage.
Okay, so it's not all doom and gloom, even in a worst-case tariff scenario.
Exactly. For one, market-implied trade tensions are already elevated. In other words, the market has, to some extent, already priced in the risk of those tariffs.
So it's not like this would come as a complete shock to the system.
Right. Additionally, a more aggressive U.S. trade policy could actually push China to implement even more forceful domestic easing measures.
It's like a game of economic chess, with each side trying to anticipate the other's moves and countermoves.
Precisely. And that's what makes this whole situation so fascinating and a bit unpredictable, to be honest. We have these interwoven narratives of domestic policy changes, global economic forces, and political uncertainties. It's a lot to digest.
No doubt about that. So, for our listener who sent in these reports, we've got this intricate web to untangle. How should someone even begin to navigate this landscape? Luckily, this Goldman report doesn't just drop a bombshell of information and leave us hanging. They actually offer some concrete advice on how investors might approach the China question right now.
Exactly. They lay out a potential playbook for investors to consider, and it gets quite specific with its recommendations.
Right, let's dive into that playbook. Where does Goldman see the biggest opportunities in the Chinese market?
So the big headline is they've upgraded their outlook on Chinese offshore equities to overweight.
Right.
These are companies based in mainland China,
Right.
but listed on exchanges like Hong Kong's, accessible to global investors.
Right.
They see the overall improved outlook we've been discussing as justification for that upgrade.
That makes sense, given everything we've unpacked so far.
Yeah.
But they also seem to have a favorite within the Chinese market, right?
Right. Tactically speaking, they're recommending a near-term preference for A shares.
Yeah.
These are the stocks traded directly on the mainland Chinese exchanges, often more influenced by domestic sentiment.
So, a bit riskier for the average global investor to access, but potentially more reward if this wave of government support really takes hold.
That's the bet Goldman seems to be making.
Okay.
They argue these A shares are better positioned to benefit from the PBOC's direct market support.
Right.
Plus, there's the potential for a resurgence in retail investor activity within China, which could further drive up those A share prices.
It's like catching the wave before it breaks out into the open ocean.
Yeah.
But I imagine not everyone's comfortable riding that kind of momentum.
Right.
What about investors who want to play a little safer?
The report addresses that, recommending A-share small mid-cap companies or broad equity market proxies as potential hedges.
Okay.
Think of those as a way to diversify your risk, just in case this whole China rally turns out to be a flash in the pan.
Right. It's always wise to have a plan B, just in case.
Exactly.
But digging a bit deeper, Goldman seems particularly bullish on one specific type of company in China right now, right?
That's right.
Okay.
They're really making a case for focusing on companies that prioritize shareholder returns.
Okay.
Think dividends, buybacks, that kind of thing.
The classic strategy for long-term investors.
Right.
Steady as she goes, focusing on companies that are sharing the wealth with their shareholders.
Exactly.
But why does that strategy make particular sense in the Chinese market right now?
Well, first off, many of these shareholder-focused companies are trading at what they consider attractive valuations, meaning there's potential for those stock prices to climb. Second, the government has been quite vocal about its support for companies that adopt more shareholder-friendly practices, so there's a policy tailwind there. And lastly, these companies tend to generate strong cash flow, which gives them the financial flexibility to actually pay those dividends and buy back those shares.
So a trifecta of attractive valuations, government support, and strong financials sounds like a recipe for potential success.
Precisely.
Yeah.
Now, shifting gears a bit, we've spent a lot of time unpacking this initial Goldman Sachs report.
Right.
Let's zoom in on that Ministry of Finance press conference from October 12th.
Okay.
Your follow-up report dives into what they actually confirmed about this grand fiscal stimulus plan.
Right, because while Goldman's report lays out the why and the how of China's potential economic turnaround, the MOF update gives us a glimpse into the concrete steps they're taking.
Right.
What actually came out of that press conference?
Well, as with many things in China, they confirmed the broad strokes of the plan, but the devil is in the details, and those are still somewhat shrouded in mystery.
Okay.
One key announcement was their plan to significantly raise the local government debt limit.
Right.
This gives local authorities more flexibility to borrow and spend on infrastructure projects and other stimulus measures.
That makes sense.
Yeah.
If you want to pump money into the economy, you need to give local governments the means to do it.
Exactly. They also announced the issuance of additional central government special bonds, or CGSBs,
Right.
which are essentially a way for the central government to raise funds for specific projects. Now, the exact amount of these bonds is still unclear, but it signals their commitment to putting their money where their mouth is.
It all sounds a bit like walking a tightrope, though, doesn't it? On one hand, they need to spend to stimulate the economy, but on the other hand, taking on too much debt could create even bigger problems down the line.
That's the delicate balancing act they're facing.
Yeah.
However, during the press conference, the MOS emphasized that the government still has capacity for debt expansion.
Okay.
Essentially saying, don't worry, we've got this.
Wow.
They even hinted at further policy measures to come, suggesting they're prepared to do whatever it takes to get the economy moving.
So they're playing their cards close to their chest, but they're projecting an air of confidence.
Yes.
Did they address the other?
The MOF signaled their support for the property sector, specifically mentioning the use of local government special bonds, or LGSBs, for land acquisition and redevelopment. Basically giving local governments more tools to support struggling developers and get those stalled projects moving again.
That's interesting, but not entirely unexpected.
Right.
But then there was this other announcement, almost like a curveball, that really caught my attention.
You're referring to the potential use of those special bonds to actually purchase unsold housing inventory.
Exactly. That sounds like a pretty drastic measure, even for China.
Yeah.
The government stepping in as the buyer of last resort for all those empty apartments. What kind of signal does that send to the market?
It certainly suggests they're willing to consider more interventionist measures to try and stabilize the property market. It's too early to say how effective this strategy will be, but it highlights the seriousness with which they view the property market slump and its potential impact on the broader economy.
So we've covered a lot of ground here, from Goldman's bullish outlook to the MOF's latest pronouncements. Yeah. For our listener who's been following this China story closely, what's the key takeaway?
At its core, China is at a critical juncture. They're grappling with some significant challenges, but they're also demonstrating a willingness to be bold, to try new approaches, and to use every tool at their disposal to engineer a soft landing for their economy. The push for demand-driven growth through fiscal stimulus is a key theme to watch.
They're writing a new playbook, and whether they succeed or fail will have enormous implications, not just for China, but for the global economy as a whole.
Precisely. And it underscores the importance of understanding these evolving dynamics, of separating the noise from the signal.
This deep dive has equipped our listener with the knowledge to navigate this complex landscape. It's about understanding the motivations, the potential rewards, but also being acutely aware of the risks involved.
Absolutely. And as with any market, particularly one as dynamic as China, continuous learning and adaptation are key.
So keep asking those critical questions, stay curious, and most importantly, keep diving deeper.